We have Ali Caruso, a Portuguese economist, Hannah Walter, a German economist, Lydia Gilbert, an expert in the fields of deficit and debt, and Hayden Klein, an influential Portuguese politician. My name is Elizabeth Katz, and I am here on behalf of the European Central Bank. Good afternoon, and welcome to this educational forum. We are here today to discuss the issue of high deficit and debt within the euro area, specifically addressing the situation in Portugal. 2 years ago, a severe recession engulfed the nations of the euro area for the first time in our 12-year existence. This recession was marked not only by negative GDP growth, high unemployment levels, and threats of deflation, but also by high deficit and debt. Today, we will be speaking about high deficit and debt because it is currently the most important issue in the euro area. As you can see on the first page of your graph books, in 2010, euro area deficit and debt stood at 6% and 85.1% of GDP, respectively. These numbers are much higher than those specified by the Stability and Growth Pact. Lowering these levels is crucial to the future success of the Union. Bailouts have already been required to address financial crises in both Ireland and Greece. Lowering high deficit and debt needs to be the highest priority for countries of the euro area. Now, to begin, Ms. Walter, can you please give us a brief economic overview of the euro area at this time?
Absolutely. As you previously mentioned, the Eurozone is recovering from a global economic crisis. There have been some positive signs. As you can see on the second page of your graph books, the real GDP growth of Eurozone nations made a huge jump from negative 4.1% in 2009 to 1.7% in 2010. The euro is also strengthening in comparison to other currencies. However, the recovery is still slow. Unemployment remains too high at 10%, with no sharp levels of decline seen in the near future.
In addition, as you can see in the third page of your graph books, inflation, which rose to 2.7% in March of 2011, is slightly above the ECB's target rate, at below but close to 2% in the medium term. Inflation, which has been on an upward trend recently, is beginning to be seen as a risk. To prevent this, the ECB raised their target interest rate by 25 basis points to 1.25% on April 7th. This rate is still low enough to allow for growth while also being a preventative measure to help curb inflation.
Thank you. Now, Mr. Klein, from the perspective of a member nation, can you please expand on the current state of the European Union and on some of the actions that they have recently taken to address the crisis?
Of course. Well, the European Union agreed on the Euro Plus Pact in March. This pact eased restrictions on the Greek bailout, increased the size of our temporary bailout fund, the European Financial Stability Facility, and agreed to create a permanent bailout fund in the future, the European Stability Mechanism, with the intention of not merely stabilizing the economic recovery in the short term, but with the added goal of assuring the long-term financial stability of the European Union and its member states.
Thank you. Now, taking into account recent actions by the European Union to help establish region-wide stability, Ms. Gilbert, can you please expand on this current situation in the euro area at large in regards to debt and deficit levels?
Sure. As you can see on the fourth page of your graph book, debt and deficit levels are still elevated in 11 out of the 17 Eurozone countries. Most nations have deficit and debt levels that are higher than what is set out in the Maastricht criteria and in the Stability and Growth Pact, which specify that a country may have debt levels no higher than 60% of GDP and deficit levels no higher than 3% of GDP. However, with no set penalty and no feasible potential penalties, countries have been able to operate well above these limits.
You are right, Ms. Gilbert. However, when countries have high deficits and debt, they experience a multitude of problems. It leads to increased borrowing, as well as a dependence on foreign investors.
In addition, high deficits and debt prevent economic recovery by making fiscal stimulus difficult and create higher yields on government bonds, which in turn lead to crowding out of private investment. Once a country has accumulated a large amount of debt, it is often very difficult for them to emerge without defaulting on liabilities or requesting a bailout, as we have seen in Greece, Ireland, and most recently Portugal.
Thank you, Ms. Caruso, for bringing us to the main topic of today's discussion. Now, to start, Mr. Klein, can you please expand on the state of Portugal before their request for financial aid?
Well, to start with, the recent global recession has undoubtedly affected Portugal. We experienced a decline in GDP growth of negative 2.5% in 2009, and our unemployment rate continues to hover above the EU average at 11.1%. Now, as you can see in graph 5, 10-year bond yields hit a euro-era high in late April at 9.5%. In addition, our original expectation of positive growth has been revised for an estimated contraction of 1.3%.
However, the primary issue is Portugal's high deficit, which, as of 2010, stood at 9.1% of GDP and the fifth largest in the Eurozone. Their public debt is also staggeringly high, at 92.4% of GDP. Despite the budget and trade deficits having lowered, investor confidence remains low in Portugal, most likely due to recent political instability.
Ms. Gilbert just touched upon political volatility in Portugal related to the economic situation. Mr. Klein, can you please go into greater detail about the current difficulties that the Portuguese government is facing?
Well, on March 23rd, Prime Minister José Sócrates resigned, and a snap general election was called for June 5th by President Silva. Current polls suggest a shift in power from the Socialist Party to the Social Democratic Party, although the gap between the two main parties has tightened in recent weeks. It can be assumed that this uncertainty was a major factor in the former Prime Minister's request for a bailout.
The bailout that Mr. Klein just mentioned was requested after spreads between Portuguese and German bonds reached a euro-era high of 484 basis points in November of 2010. These unsustainable levels represent low investor confidence due to elevated debt levels. Ms. Caruso, how did Portugal come to get such high levels of debt and deficit?
Well, as you can see on the 6th page of your graph books, our debt has steadily increased since 1998. Fiscal irresponsibility has increased Portugal's gross debt from 10 percentage points under Maastricht regulation to more than 30% above it in just the last decade. This debt reflects a long-standing culture of unsustainable government spending, which has caused this current crisis. Factors such as high military spending, a generous social safety net, and post-recession fiscal stimulus have all contributed.
The factors that brought about the Portuguese bailout do differ from those that brought about the bailouts of Ireland and Greece. However, Ms. Walter, do you believe that the precedent set by the previous two EFSF and IMF bailouts could be useful for Portugal in recovering from their crisis?
It's a possibility. However, the extremely high interest rates on both these bailouts should serve as a warning to the lenders. Interest rates on these bailouts stand at 5.2% in Ireland and 5.8% in Greece. The high rates have threatened the ability of these nations to deal with their debt and deficit issues.
The high interest rate is definitely a problem we've seen in other financially rescued countries. Both Greece and Ireland have tried easing the terms of their bailouts because they fear they cannot repay their loans. Bailouts come with inevitable restrictions, regulations, and sanctions, which could stifle growth and make it more difficult for these countries to repay their loans in the future, possibly pushing them back into recession. The austerity measures that come with this bailout will be more severe than the ones previously enacted and proposed in Portugal, which included 5% public wage cuts and raising value-added taxes to 23%.
Mr. Klein, while the restrictions that are imposed may seem extremely strict, they're quite necessary in order to prevent moral hazard. Bailouts are not prime solutions, but must be employed in certain situations. When countries face long-term economic difficulties due to high deficits and debt that may be caused by such problems as low productivity or an uneducated workforce, bailout money may help these countries solve their deficit and debt issues.
Ms. Gilbert, although I understand your point of view, Mr. Klein makes a valid argument. A bailout from the IMF or EFSF will come with draconian austerity measures as well as mandatory reforms. In countries that already have slow growth rates, measures such as tax increases and cuts in government spending may depress these economies even further, pushing them into recession. This is a real fear for Portugal, who is already experiencing a contraction. Who already experiencing contraction. This has been seen in Ireland as well as the United Kingdom.
Well, given all of this, let's discuss the Portuguese financial aid package. Mr. Klein, can you please describe some of the factors that led to this request for financial aid?
Well, in the short term, Portugal has 9 billion euros worth of redemptions due in April and June. With the funding from recent bond auctions, Portugal was able to meet the April redemptions, totaling 4.2 billion euros. However, the country's financial reserves are near depletion, lacking enough funds to meet the 4.9 billion euro redemptions in June. It has become increasingly difficult for Portugal to repay its debts, and its high bond yields, coupled with the public's strong opposition to austerity measures, have left the country in desperate need of a bailout.
However, with Portuguese inflation high at 4% and a euro increasing in value against the dollar, this bailout will be difficult for Portugal to repay. In fact, the euro reached a 16-month high today against the dollar at 1.465. This and the recent downgradings of Greece, Ireland, and Portugal's debt threaten the overall success of a bailout.
The details of the bailout, requested in early April, won't actually be released until mid-May. However, there's much speculation as to what the plan will entail. As a very rough estimate, the European Commissioner responsible for monetary affairs has predicted an aid program worth about 80 billion euros. Other sources have said the funds are expected to be used to cover Portugal's short-term debt obligations and cash shortfalls at public service companies, and to repay loans made to nationalized bank, Banco Português de Negócios.
Thank you. Now, Ms. Walter, moving back to one of the largest issues at hand, how do other Euro countries, in particular Germany, feel about this Portuguese bailout?
Germany has generally been averse to any bailout because of the effect on our taxpayers. We were very large contributors to both the Irish and Greek bailouts, which made enough of an impact on our population. In fact, the bulk of Greece's bailout fell on Germany, who fronted 22.4 out of the 110 billion euros, more than 1/5. As you can see in the next page of your graph books, Greece's bailout was a huge burden to these countries and their taxpayers. And while it is better than the option of default, a Portuguese bailout is just more of a burden to bear.
While the German public was not necessarily in favor of this bailout, many suggested that significant governments were in favor of it. This is because it takes a step towards ensuring that Portuguese debt does not spread to the much larger economy of Spain through systemic risk.
In fact, recent Finnish parliamentary elections showed huge gains for the two Eurosceptic parties, the True Finns and the Finnish Social Democrats, who collectively gained 31 seats in parliament and could combine to form a near majority. If they create a coalition, Finland could fail to vote for the Portuguese bailout and instead try to delay or change it. This is representative of the growing belief in some Eurozone citizens in that countries must fix themselves without aid from a Euro-era bailout.
When countries are contributing so much to bailout funds, we must recognize that often bailouts are not the only thing necessary to achieve long-term success. One of the things that often impairs growth in struggling nations is the extremely high cost of borrowing. Is there any way to lower this?
There is, Ms. Katz. An interesting way to lower borrowing costs in peripheral Eurozone nations would be with a pan-Euro bond. A pan-Euro bond would be issued by the ECB and then transferred to the peripheral Eurozone countries who applied, in conjunction with their own sovereign bonds. These funds would then be used to spur growth or solve overall economic difficulties within a nation. These bonds would be insured by the European Commission, thus having much lower yields. These bonds would also come with restrictions, and the ECB would have the ability to raise the interest rates on each specific bond.
This could be a terrific way to help peripheral Eurozone countries get back on their feet. Pan-Euro bonds in Portugal could be used to counteract slow growth, increase productivity, or invest in education.
This is extremely important, as education reform is necessary to create the foundation for a successful labor force in Portugal's long-term future. With only 11% of the Portuguese population having received higher education, an unskilled workforce has discouraged investors. With the increase in outsourcing of low-skilled laborers, Portugal needs an educated workforce to attract advanced employment opportunities. By investing these funds and lowering the dropout rate, it would lead to a better labor force, lower structural unemployment, and increased tax revenue.
In addition to investing in education, there are other ways that the funds from a pan-Euro bond could be used to spur growth and job creation in Portugal. For example, Portugal imports over 85% of their energy, which has led to half of their trade deficit. It would be beneficial for the Portuguese government to establish a GSE, or government-sponsored enterprise, with the initial funding taken from the revenue of a Eurobond. These funds would then be invested in research and development of alternative energies, with the product eventually being resold to other Eurozone nations at a discounted price.
Interesting. Ms. Caruso, can you please go into more detail about exactly what a GSE is?
A GSE is a middle ground between a private corporation and a completely government-regulated program. Portugal's environment should be able to lucratively sustain hydroelectric, wind, and solar energy, with the energy then being able to be A, exported to nations such as Spain as a new source of revenue, or B, reduce Portugal's dependency on foreign oil. The GSE should not greatly increase their debt and could potentially save them billions of euros a year.
This is a very
In addition, once this endeavor breaks even, it will be a new source of income for the Portuguese government as well as a source of job creation.
This is a very interesting approach and would actually comply with the Europe 2020 Pact, which focuses a great deal on green energy. Its main goals are smart, sustainable, and inclusive growth. It is essentially a plan for the coming decade and a way to recover the Union. If implemented correctly, it will assist member nations in coming together to reach high levels of employment and increased productivity.
In conjunction with the bailout, these measures should help Portugal to recover from their debt crisis. However, this will require continued action by both Portugal and the rest of the Eurozone. Portugal must work to reform the unsustainable nature of their finances through continued...
Thank you very much indeed.
So one of the things that, thank you very much for your presentation. One of the things that you mentioned is the ECB and its effect on interest rates. Why do you think that the ECB raised interest rates? You described it a little bit, but please go a little bit more in depth. And do you agree or disagree with its decision in terms of the impact that it had on the Eurozone?
Well, because the ECB's single mandate is price stability, they recently raised their interest rates because they saw that interest rates had been going up recently and were predicted to go even higher. Ms. Katz.
Yes, inflation has been going up recently, mainly due to higher oil and energy prices, mostly resulting from political instability in the Middle East. I do agree with this rise in interest rates because while it may harm peripheral nations who are not doing as well, the ECB's single mandate is price stability. So their main focus needs to be inflation in the euro area.
Thank you.
Some commentators have predicted that the crisis currently affecting some countries in the euro area will lead to a breakup of the euro. What do you think about that?
Well, we don't believe that this will happen. The euro is very adaptable, and that's one of their main strengths. Right now, we've seen a lot happen through this crisis, and they have reached out to these countries such as Greece and Ireland and Portugal soon. And we don't believe that this will bring down the entire union, but actually just fortify it. Ms. Walter.
In addition, we have to take into account, especially with sanctions that are applied to bailouts, at what point is the Eurozone going to stop punishing countries for having high debt and help them recover? This is why we suggested Eurobonds. We have to really take into account that the Eurozone cannot survive as a bifurcated economy with countries like Portugal and peripheral countries on the bottom and countries like Germany and France who are succeeding near to the top. So if they manage to help these countries recover, not just from short-term liquidity issues, but also in the long term, then the euro does have a very successful future ahead of it.
Ms. Katz.
In addition, we must take into account how dedicated every country in the euro area is to the concept of this common currency. I think that this dedication is what's really going to pull the euro through.
Okay, I'd like to go into a bit more detail into your policy recommendation for Portugal. And you actually mentioned German resistance to bailouts, and you said, why should Germany pay pay for the sins of others? But in your proposal is you want a pan-euro area bond. Okay? So I'd like you to imagine what Germany's reaction would be to the idea of a pan-euro bond. Would Germany be in favor or against it, and why would it be in favor of that solution against the other solution?
Germany would most likely not be in favor of a pan-euro bond because if a country such as Portugal were to default on a pan-euro bond, then Germany would be responsible for paying back part of this money. However, as we just said, the Eurozone has to come up with solutions that will help these struggling economies, and the Eurobond, because of the restrictions we would have applied to it, and because of the sanctions, it would be one of the most successful and least risk ways to achieve this goal.
In addition, the pan-euro bond would probably not do much for Germany. If they utilize it, it might actually increase the rate of their borrowing, seeing as they do have to take into account for these other economies. So it just wouldn't be that much of a benefit for it.
Why not just let Portugal default on its debt?
Well, we can't let Portugal default on its debt. As we saw in the 1990s in Asia with the downfall of the Thai baht, it consequently led to the downfall of the surrounding Asian countries, such as Indonesia and South Korea. This then led to those three countries having to be bailed out, and it severely hurt the Asian economy as well. Portugal is so much more tied to these economies than Thailand was. They share the same currency, and they're part of the same union. We have to see these similarities, and it just might be an extreme domino effect.
I have a question. You also had talked about how a lot of countries that issue debt are at the mercy of foreign investors who can influence the rates that they pay. Why do you think it's bad to have a majority of their debt in the hands of foreign investors, or what's the benefit of having their bonds owned domestically for your plan?
Ms. Gilbert.
Well, one of the main drawbacks of issuing bonds and issuing debt to investors is the fact that there are redemptions in the long term. Portugal is facing huge redemptions, as Mr. Klein mentioned in the presentation. So this is definitely a drawback because in the short term, countries may not be able to fully refund these redemptions and fully be able to find the capital necessary for them. This is a definite drawback of issuing debt to investors.
Right, and so how would you control the effect of the market on the pan-euro bond? Because there's also a market interest rate in addition to the ECB interest rate.
Well, the
market interest rate, we wouldn't really control it. I mean, to a certain extent, that the ECB we wouldn't necessarily set it. But what we mentioned about the ECB raising interest rates would be for the individual countries. So the investors would still get the rate they purchased the bond at. However, if the ECB saw that the individual countries weren't complying and they were being kind of riskful, they would raise it for them, and then they would take the individual money and maybe invest it in bailout funds or something like that.
Okay, I'd like to explore really the diagnosis of what's gone wrong in Portugal. You seem to put a lot of emphasis on unsustainable government spending, and you said that this has been continuing for many, many years. So, is the problem really unsustainable government spending, or is it really slow growth? Is it the numerator or the denominator of the debt to GDP figure? Where does the problem really lie?
Mr. Klein.
Well, from what we've seen in some of Portugal's spending, a lot of it does have to do with that. Portugal does have a really unnecessarily large budget for its military, and some may suggest cutting some of that in order to bring Portugal's deficit down in the short term, as such a large budget for that is mostly unnecessary.
Ms. Walter.
However, we have to take into account that slow growth is affecting their ability to pay back their debt and deficit. Even before this most recent crisis, Portugal had one of the lowest growth rates in all of the Eurozone. And due to this recent crisis, due to austerity measures and other sanctions, they're expected to contract another 1.3% in this recent year, which should just make the redemptions even harder to pay back.
Okay, so let me ask a follow-up on that. You said slow growth was in fact part of the problem. And let me put to you that actually it's a good thing for Portugal to have this bailout because it will come with reforms that will help to raise the growth rate. You seem to be implying that austerity measures, fiscal austerity measures, and reforms that would come with the bailout will be unpopular and would actually make things worse rather than better.
Ms. Walter?
I think for this question, you have to look at the situation in the United Kingdom. Recent rounds of austerity measures have really slowed growth a terrific amount within their country. In the past 3 quarters, growth rate in the UK has dropped from 1.2% for the 3 quarters ago, and in these recent austerity measures, it was at negative 0.7%. Recently, it has grown 0.5% as of today. However, it is still, you've seen a stall in their economy. Portugal, these effects would even be amplified due to the fact that they already have one of the slowest growth rates, which was not seen in Portugal, in the United Kingdom, excuse me.
Thank you.
Do you think there should be stricter punishment for the countries that have violated the debt and deficit rules, and especially if you're going to put together a pan-euro bond? Don't you think that would be necessary to get investor confidence?
Ms. Katz.
I do think so. In 2005, the Stability and Growth Pact was reformed to make the punishments for countries who do have excessive debts less strict than they had previously been. I think that partly due to that, countries have been, such as Portugal, have been spending irresponsibly. So I think this is something that should be done.
Mr. Klein.
However, we must look at the other side of this question. If such punishments, such as sanctions, are imposed on countries that breach the Stability and Growth Pact, we could see them increase even more in their debt and deficits, and this would just be counterproductive to the whole idea of punishments.
Ms. Walter.
You also have to look at, in addition to whether or not they should have punishments, but how will these punishments be applied. If we look at the history of sanctions, there originally were sanctions for the master criteria. They came in the form of these blue sheets. However, the first countries that violated the master criteria were in fact Germany and France. And then they did not pay these fines that came into these blue sheets. And then every other country since then has said, well, the first countries didn't pay them, why do we have to do that? So if we were to apply sanctions, you would really have to overwhelmingly reform the entire system of sanctions.
Okay, thank you very much indeed for your presentation.